we seem to be asking people to put up their hands, so I'll do the same. How many of you have heard about the Trump tax reform? Lots and lots. Better than last year. So the Trump tax reform, also known as the Tax Cuts and Jobs Act, is basically the biggest US tax reform in about 31 years. The last big one was back in 1986. The centerpiece of this TCJA basically is a huge reduction in corporate tax from 35% down to 21%. So that's a 40% haircut on the corporate tax rate. And as well, for the first time in the US tax history, they have introduced what we call a territorial system, where when you think about, say, Apple, it has subs everywhere, right? So say that the sub in China pays its earning back to the US parent. In the past, that would be taxed in the US. But with this reform, there's a new provision in the code that basically says if a dividend is coming out of a foreign sourced income, that dividend does not get taxed when it's paid back to the US parent. So that's like basically flip the world upside down. Because, like I said, that has never happened in US tax, but with this reform, that's what's happening. So when you think about it, now they got a much lower corporate tax rate at 21% and a smaller base because now dividends coming back to the US doesn't get taxed, right? So the IRS and the Treasury probably are looking at a lot less cash flow and revenue. So what do? They say, that's fine. We're gonna tax all your earnings from 86 up to 2017. Earning meaning that earning that's quote unquote earned by the foreign subs of the US parent. So there's this new tax, what we call the deemed repatriation tax, that basically says if you have a CFC, and CFC basically means when a foreign corp is controlled by a US corp. Okay, so when you have a CFC, or when you don't have a CFC, but when you have a 10% US corporate shareholder, this tax applies. And this tax is based on the earnings of the foreign sub, like I said, back to 1986. So imagine doing the calculation for 31 years and figure out what the tax base is for this tax. That's a lot of firms, that's exactly what they had to do. And the IRS was very clever in that they had two measurement dates because news of this tax was leaking out in late 2017. So big corps were doing all sorts of nice tricks trying to minimize what we call EMP. Basically the measurement of what that foreign sub's earnings would have been. So the Treasury said, okay, there's two measurement dates, November 2nd or calendar year 2017, and you take the bigger of the two. Because the companies were doing all sorts of fancy stuff trying to minimize that, so they said, fine, we'll do it that way. So a lot of tax planning went sort of for nothing. So the measurement date basically is the greater of those two dates. And on top of that, there's two tax rates. 15.5 for earnings that is deemed to have been tied up in cash, and then a lower rate, 8%, on earnings that's tied up in other assets. Why are there two rates, you ask? Well, again, the Treasury is very smart. They say, look, if you had earnings in a foreign sub that you choose not to have that paid back to the US, meaning tied up in cash, we're gonna penalize you for that. So there's a higher rate at 15.5. But if that earnings were required for the operation of the foreign sub, i.e. tied up in other assets, we don't see you as trying to sort of game the US tax system. So we're gonna give you a lower rate. So that's the policy perspective behind the two rates. The only good thing about this tax is that if you make the proper election, you can pay this tax over 8 years. versus having to pay it all at once. So this is a pretty heavy tax. And the other bad part about this is a lot of the individual US shareholders offshore who have, say, Canadian companies, they're also caught. This does not just apply to multinationals. This applies to every US person, individual or corporate, that has a non-US company that they either control, or when they don't control, when that foreign corp has at least 10% US corporate shareholder. So this net is wide and deep. And with this new tax, obviously, there's a lot of new reporting. The Form 5471 got revamped. It's basically now twice the size as before. The IRS was scrambling last year to deal with this tax because they didn't have time to think about sort of how to report it, because the law was passed in really late December. So basically for the last reporting period, or the first year that this tax applied, the IRS had this sort of ad hoc 965 statement that you do. Now it's a new form replacing that statement. But the IRS was scrambling to sort of comply and to sort of put out guidance for this tax. So think of 965 as the past, because that tax's goal is to tax the earnings and profits from 86 up to 2017. Then what happens from 2017 on, right? So like I said earlier, the US has moved from a sort of worldwide system to a territorial system, but they also put in this new tax called Global Intangible Low Tax Income, or GILTI, and that's not an accident. They meant to say GILTI. So this is what we in the tax circle call a turbocharged Subpart F. Because in the past, Subpart F only caught certain types of income, primarily passive type of income. But with this tax, it catches literally everything. Because how this tax is calculated is that they take the tested income of the CFC, a controlled foreign corp, and then they yank out stuff like Subpart F, okay? And then they allow you a 10% return on the tangible assets. And then after that, everything gets taxed. So unlike Subpart F, where it's very focused and very targeted, this is a catch-all with carve-outs for specific types of income and a 10% return on tangible assets. So a lot of people thought when this came out that, hey, you know, intangible means stuff like patent and copyright. So if my CFC doesn't have that, then I don't need to worry about it. 100% wrong. Everything gets caught here. The only good part about this tax, or actually there's two good parts about this tax, is there's a 50% deduction that they give to all the US corporate shareholders, as well as a foreign tax credit capped at 80% of what the sub paid. So when you do the math, basically the end result, despite the wide scope of this tax, is that this tax doesn't really apply if the foreign corp paid a corporate tax at 13.125%. Basically, you know, like the new corporate tax rate, then you account for the foreign tax credit. So that's sort of two things that made this tax a little bit easier to bear. But the other bad part, you know, just like the old tax on all the earnings, is that this tax also applies to individual shareholders who own, for example, Canadian companies. So again, you know, even though when they wrote the law, everybody was saying that, you know, the sort of the underlying premises was to make multinationals pay for the earnings that they have, quote unquote, hidden in their subs. Unfortunately, the way that the law is written, this tax catches everybody, corporate or personal shareholders who are US. And then the IRS guidance on this whole thing is still ongoing. Like they have had guidance back and forth, notices left and right. And obviously, with this new tax, there's also new forms that are targeted specifically on how you calculate GILTI and how you sort of pay it. Oh yeah, and this one is a doozy. And we see this a lot, right? So say you have a Canadian parent that has a wholly owned US sub, and that parent also happens to have a Canadian sub, okay? And the US sub has no stake whatsoever in that Canadian sub, brother-sister court, right? Okay. Under the old rules, that Canadian sub, from a US tax perspective, is not a CFC. After the tax reform, that US sub, you guessed it, is now a CFC. Because the shares that the Canadian parent owns is deemed to be owned by the US sub. So you have a US sub then who fictionally own 100% of the share in that Canadian sub. So that's a CFC. And once you have a CFC, obviously, everything that comes with a CFC come into play. For example, what is your GILTI tax? What is your subpart F? What is your reporting under 5471? But luckily, for the subpart F and the GILTI calculations, even though there's a CFC, there's no pickup because there is no direct or indirect ownership. So subpart F and GILTI is okay. But before the IRS came out with a clarification, everybody's view was that 5471 would have been required because once you have a CFC, that's what's required. And that reporting carries with it a $10,000 penalty for each and every form that is late or missing. And this is one of the few cases where the IRS actually came out with a notice, and then they followed up with a renewed form that basically says, look, if you are a CFC solely because of constructive ownership rules, which this is, then you do not need to file 5471. So basically the IRS saw the flaw in the law and they righted it. So in this situation, even though you have a CFC, there is no pickup and there's no reporting. And we see this quite a bit too. So think of a situation where you have a Canadian partner that is partnered in a US partnership. And then at some point, the partnership interest is sold. Does the IRS get to tax that if there's a gain on that sale of the partnership interest? The IRS for about 20 years said yes, that is taxable. Until a court case back in July of 2017 that goes, no, IRS, you're out to lunch. The taxpayer did not sell the underlying assets. The taxpayer sold partnership interest because the IRS's argument is that we look through the partnership. Therefore, to the extent that the partnership had US trade or business, that gain should be taxable in the US. But this court case back in July of 2017 overturned that and said, no, that is not taxable. So what the IRS can win in the courts, they managed to just change the law. So now there's a new code provision under 1446F that says not only is that sale taxable, they doubled down and said there's a 10% withholding tax on the gross proceed. Okay? And the way the code is sort of worded, you can have a situation where that partnership, say, has both US business and non-US business. The way that the code is written, the entire proceeds is subject to that 10% withholding. So there's no proration rule here. And we see this a lot too, unfortunately. So we see LLC a lot, right? Because that's what US people use, right? Limited liability companies, right? And the reason for that is there's only one layer of tax because, because a US LLC generally is a disregarded entity unless you check the box to be a corp, okay? But for reporting purposes, specifically for 5472 purposes, that LLC, even though it's a tax nothing for federal tax purposes, it is a corp for 5472 purposes. So what that means is that if you have a Canadian corp that holds a US LLC, guess what? That LLC better be filing a 5472. Or when you miss that, there's a new $25,000 penalty for that. So at 1.3, foreign exchange rate, that's like $33,000 for something that you didn't tell the IRS. So that's highly punitive. And I won't go into the sort of the other tax issues because an LLC, by virtue of being a hybrid, because it's a corp from a Canadian perspective, but it's a tax nothing from a US perspective, from a treaty point of view, you also get whipsaw. So basically, the takeaway here is just that after TCJA, the US tax world is not friendly at all. It's very complex, it's very challenging. The guidance from the IRS is still coming out, and it probably will be so for another year or so. And there is for sure increased reporting and increased penalties.